Hey guys, what's good? I'm Andre and today I want to talk to you guys about generating passive income, generating premium on a specific put options play. We're gonna be selling puts and potentially reaching all-time lows in terms of average cost for a stock here. It's ChargePoint, lo and behold, it's on the screen. So for any of you guys that know what puts are, know what the wheel is, know how to run it, feel free to steal the idea, drop a thumbs up down below and go see about your day. I'm happy if I can provide some sort of value to you guys. Now, for everybody else, I want to break this down and see if it's a feasible idea for you guys. But first off, is it good enough to generate 90% year-over-year returns on your portfolio? In my opinion, if you are doing that, you're absolutely killing it, and ChargePoint is now giving us the opportunity to keep the benchmark that high. And we're gonna look exactly at how we are going to be able to do that. Now, what I want to look at first, guys, is just ChargePoint's fundamentals. I'm gonna start with the worst news first. So the worst news is that these guys are generating revenue, but it's not enough, and they're actually generating bigger and bigger losses as the years go by. As you guys can see, their net income for 2023 is bigger than their net income for 2022. This is obviously not ideal, and their debt has been growing year over year. As I was telling you guys in the Mulan video that I did last week, we're not looking to become an NBA all-star player when it comes to fundamentals. We're simply looking to understand kind of on a base level what this company is about. So with a company generating more and more debt lately, not more and more cash, I mean more cash but not enough basically. They're investing way too much in growing their EV stations. They are highly negative free cash flow, and actually the free cash flow amount is going more and more negative year over year. And we can also see the fact that they're issuing more and more stock lately. In 2022 it was pretty rough, but 2023 wasn't amazing either. So all these are factors that are adding pressure on an otherwise underperforming stock anyway. So when we look at the stock here, guys, it's retraced back into this same area. I was telling you a while back that we are forming a double bottom. Now, for it to be a double bottom, we would have had to burst up over the peaks that have formed between these valleys. Now that didn't happen, so we are now potentially creating a triple bottom. We're gonna see if that plays out. We would have to burst above $20, give or take, for that to be a valid double bottom, and right now it looks a bit unlikely, but we're not looking that far ahead, guys. We're simply looking at potentially selling an $8 strike price put here with the price currently very near all-time lows. Now I'm gonna construct this for you guys and let's look at what it looks like, because if we go out in the 21st of July here, which is basically going to be a month and a week or so, and we sell the $8 strike price put, that allows us to generate 62 cents of premium. Now 62 cents per contract, that's $62. So let's do the math here, guys. We generate 62 cents per contract for collateral that we put up of $800. That means that we generate a whooping 7.75% ROI in that period. And let's say that we are able to generate the same ROI roughly 11 months out of the year. That gives us the ability to generate roughly 85% ROI on our portfolio. So these are the type of deals, the type of setups that I look for when I sell cash covered puts or when I sell covered calls. I want to make sure that we have that premium, that alpha, and I don't always go for generating stock collateral kind of appreciation. I want to make sure that I actually get the premium, not the appreciation. I'm not as much interested as I am in the premium when it comes to stock appreciation. Now, guys, that's pretty much it in terms of the strategy here. If we do end up selling the $8 strike price put, let's pretend that by expiration, which is gonna be again July 21st, let's pretend that ChargePoint goes below $8. That means that we are assigned 100 shares per contract, and that also means that we keep the $62 in premium. So when we keep $62 in premium, that means that our new average cost for the 100 shares per contract that we get assigned is now $7.32, or 38 cents, sorry. So with $7.38, that would basically put our average cost over here, where I'm going to draw this red little border. And honestly, guys, that gives us all-time lows for this stock. I think that this is a pretty decent level to sell some cash covered puts here. I don't really understand why we would all run to the hills when it comes to ChargePoint just because that news piece hit, because Tesla isn't, I mean, we all know what the state is here. Basically, ChargePoint is the leader in EV charging stations in the US and basically throughout the world as well. If you guys take a look at one of their investor presentations, you're gonna see what I mean, but they're not making money. So this is a company that wouldn't as much be faced by competition as is by just making sure that they do some internal cleaning and making sure that they narrow their costs so that they can increase their margins and they can finally make some money, break even, or even become profitable. With that said, guys, this covers today's video. Please feel free to check us out on Patreon for more ideas like these. For just $5 a month, you get all of that. I also post a lot of free content on there. Feel free to check me on Twitter. We are at Trading Crew US. And then definitely feel free to drop a thumbs up and a subscribe if you've enjoyed the content. I'm gonna catch you guys next time. Take care.